This conference will now be recorded.
We've got quite a few people on tonight. I appreciate you all being here, and we're going to have a good presentation, I hope. So I've got everybody muted. If for some reason somebody unmutes themselves, I'm gonna keep everybody muted until the end, where I think we'll have enough time I can open it up to some questions. If you've got a question as we're going along, there's a chat box on your controls where you can actually type in your question, and I'll be able to see it and answer it here. Also in that chat box, I've already dropped in a link to my calendar. So if you wanted to schedule an appointment to talk with me about anything that we're going to cover tonight, you can click on that link and schedule an appointment. Of course, you can always email me or call the office and we can get that accomplished that way too. But all right, so without further ado, we'll get started. My name's Ron Ray, and I am a financial advisor here in New Braunfels, Texas. We cover San Antonio and Austin as well. And we mainly deal with people who have gotten to that point of retirement, and you are now going into retirement, into the distribution phase. So you've already saved all of the money that you are going to make, and now you've got to make that money last. So that's kind of where I come in. I help you get down the mountain safely back on that other side. So one thing that you may have noticed is that we've had some problems with the market lately, and that can be a little scary. Sorry if I get a pause. As people sign on here, things pop up on my screen and it gets distracted for me. So that's okay. The market's kind of gone crazy, and I was talking to one of my colleagues about doing this bear market presentation today, and I was talking to him last week, and he said, well, you know, Ron, this bear market's almost over. You know, it's kind of too late to do a bear market presentation. And my response to him was, well, I'm not sure that. I just don't know if this bear market is over. And sure enough, you know, what happened today? You look at the market and the stock market, the US stock market, and the Dow Jones dropped almost 1,900 points. S&P 500 down 188 points. We looked at that a percentage. Dow Jones dropped 6.9%. S&P down 5.8. Even the NASDAQ was negative today, 5.25%. And for the last couple of days, you know, we've had a down market. So I'm not sure that this market is over. I'm just not sure. We'll talk about some of the things that are leading to this and lead me to that estimation. But we look at the fear index called the VIX. This is a gauge, an index that measures people's expectation of volatility in the market. We consider anything under 20 being safe, you know, good market conditions, with not much volatility. And it's been over 20 for several months now, and it was creeping back down to 20. Today it popped back up 48 points. It's back up over, 48%. Back up over 40 now. So we're not out of the woods yet. We'll talk about that. All right, so get right into it. We're kind of in unprecedented times, and I know that phrase has been used a lot lately. You're hearing that in every walk of life, whether it's on the news or in various different industries. You're hearing it. But it's true. We're in unprecedented times. We're in the middle of a global pandemic, and businesses are being shut down. People are being forced to work remotely if they're not being laid off or furloughed. Retail stores, brick and mortar stores are closing their storefronts. Everybody's having difficulty getting resources, just simple resources that you take for granted, like toilet paper and meat. Or we're finding it hard to get these things. Some cities, most of the country, in fact, have shut down, not allowing people to really, except for certain essential activities, leave their house even. And also in the midst of that, we've seen the return of some of the heaviest market volatility that we've seen since 2008. So yeah, it's unprecedented. And I don't know if you've ever seen this, but as a financial planner, this kind of hits home. The boxer Mike Tyson once said, everybody has a plan until they get punched in the mouth, and then that plan kind of falls apart. And we hear phrases like this and quotes like this in the military. And, you know, I've got a law enforcement background, and, you know, planning is essential, but plans generally just don't work. No plan survives first contact. And of course, if you know anything about boxing, you know that Mike Tyson didn't actually say it. Wasn't actually the first one to say this. It was actually Joe Louis, but Mike gets credit for it. So that plan, even though you may have a good financial plan, was it really prepared for the times that we're in with this black swan event of the global pandemic, together with the oil war between Russia and Saudi Arabia that drove our oil prices down, all put together with perhaps an overinflated stock market, has made some of these plans kind of fall apart. So let's just compare the last bear market with the current one. So 2008 was the last one. So just compare some of the things between what we're experiencing now. What caused the 2008 bear market was caused by some poor and risky lending practices in the mortgage market, the home mortgage market. And this one was kind of set off by the coronavirus that started in China and then spread quickly to the rest of the world. It was started in 2008 with a housing bubble, so the real estate market was overinflated and caused by these poor lending practices. People that shouldn't have been allowed to buy houses were allowed to buy houses, and then when they started to default on those loans, then that burst the bubble and it all came tumbling down. In 2020, the number of cases of the coronavirus slowed or halted manufacturing in China. And where does the world get most of its goods and parts and supplies for manufacturing around the world? Well, most of it comes from China. They're the world's second largest economy and the largest exporter of goods in the world. So if they can't work and they can't get their goods out to the rest of the world, well, that slows our economy down as well. So the world that we live in is all very connected. Our economies are very connected. They're global economies, and something that happens on the other side of the globe definitely affects us here. 2008, the foreclosures, lots of people lost their homes, and in 2020, lots of products and service businesses used for their production were used in China, caused the supply chain disruptions. In 2008, investors had little confidence in the mortgage and loan markets, and in 2020, that virus began to spread here and to other global markets. In 2008, loans and credits were no longer easily available, which further drove the markets down. And in 2020, add to the coronavirus, this disagreement between Russia and Saudi Arabia over oil prices drove down the oil market, which has effects on other markets. So when the oil prices dropped, that also had an effect on high yield bond rates. So all your retirement plans, where when you were getting closer to retirement, you moved your money out of the stock market and more into income products like bonds. Well, those bonds are highly tied to the global interest rates, and those were affected by all of this as well. 2008, we had liquidity issues, which causes more people to sell and prices to drop even faster. In 2020, sell-offs in stock and bond markets caused, because of uncertainty and worry about the economic outlook. And 2008 resulted in a bear market that took till 2015 to recover. So it took, for most markets, it took all the way from 2008 to 2015 to recover from that. And 2020, well, it's a little uncertain what's going to happen. You know, some people were pretty optimistic last week, but when you look at what happened today, what's been happening over the last couple of weeks, you can kind of see that V-shaped recovery start kind of wandering off to the right a little bit, and it's not quite V-shaped anymore. And I'm not certain that we're out of the woods yet. So how do we know that we're in a bear market? Well, there's some economic indicators that the experts use to determine, okay, yes, we're in a bear market. So a bear market is opposed to a bull market, which is an up market. A bear market is a down market. And so the experts in Washington and at the universities and at the Federal Reserve will just say, okay, we're in a bear market. But really what leads to that and what gets us there is we have this unforeseen negative fundamentals in the market where the market's getting overexpanded and the fundamentals don't quite add up to what's actually going on in the economy. And then which we've been actually the last bull market that we were on, that run from 2009 up to where we were at, it's the longest bull market in history. Well, these things cycle and they have, typically we have a recession, or not a recession, but a market correction, a good strong market correction, meaning a downturn about every 5 years. Well, it's been, 13 years since we've had that, really seen that. So we're definitely overdue. And what that causes is kind of a sense of euphoria with investors. So we've been doing so well for so long that investors are just euphoric about it and not really paying attention to what's going on. And then plus you add in this big unknown that nobody could have seen coming called the coronavirus. That could have also been a terrible hurricane in the Gulf. It could have been somebody started shooting missiles overseas. Who knows? It's something that's a big negative and no one saw it coming. You add all of those together, and what does that get you? It gets this big crash in the market, and we call that a bear market. Now, we don't know what the future holds, but what we do know is that there are always ways that we can better prepare for these uncertain times, especially right before and during retirement. So when you're young and you're working and you're making lots of money, you can put it away, and these are the times to actually put more money into the market and buy more. But when you're retired, you're not doing that anymore. You're not putting any more money in. You're only taking money out. So you got to be very careful, and your strategy has to change. The retirement red zone, we call that. There's two ways to look at this. Either the retirement red zone, which is the 5 to 10 years before retirement. That's where when things are critical in kind of down times and bad times, we'll really look at this retirement red zone. Always, when I'm doing financial planning for people, I look at those 11 critical years of retirement, which is the 5 years before you retire, the year of, and then the 5 years after retirement. These are where you've got to be very careful, because things that you do, decisions that you make before you retire can affect your retirement for the duration of your retirement. And then once you stop working, you've got to be very careful with your decisions and with your behavior, because they can affect your retirement and your lifestyle for the rest of your retirement. It's very important. So what's most important about the red zone is that this is when your savings are most at risk. Okay, and they're most at risk, not just because of the market. We know that the market's going to cycle. That's a given. That's a kind of a law of nature. The market goes up, and then the market goes down, and then the market goes back up, and then the market goes down. And over time, it trends upward. But these three different types of risks are the really kind of ones that you can control, or at least control your planning for. And these are the most serious ones when you're in that retirement red zone. And we've got sequence risk, longevity risk, and behavioral risk. And we'll break each one of these down. So sequence risk kind of goes like this. Many people focus on the average annual returns of their portfolios, but it's actually the sequence of those returns that makes a bigger difference. So let me explain. The reason it's different is because you're taking withdrawals. So it's the average annual return is much less important than when those returns come in, simply because you're taking money out. So if we can look at this chart here, what you'll see is we've taken some actual returns of the market, the stock market, S&P 500, from the year 2000 to the year 2014. And you retired in the year 2000, and you needed to start taking out about $40,000 a year out of your retirement portfolio, and you started out with about $850,000. And then we're adjusting these withdrawals for inflation, looks like about 2% per year. And then we're adding in the actual returns of the stock market. So if you were invested simply in the US stock market, this is what you would have done. Okay. So you can see here, if you go through the years, you had three bad years right in the first. So this is that dot-com bubble, 9/11, trying to recover after 9/11. And you can see you had 3 down years in a row. But because you were retired, you needed money. You couldn't stop taking money out of your account simply because the market was down. You had to still live your lifestyle. So you had to still take that money out. So you can see you took $40,000 out, and then you lost 10%. So now you're back down to $858,000. Then the next year, you needed to take out a little bit more because of inflation. So you took out $40,800, and then you lost 13% to the stock market. So now you're down to $705,000. And then the next year, you needed to take out a little bit more. So you took out about $41,600, and then you lost 23% to the stock market. So now you're down to under $500,000. Okay, and you can see how that goes throughout the year. And your average annual return, you add all these up and average them, is 4.07%. Okay, and after you've taken your withdrawals, you still have about $273,000 left. Okay, so those are the actual returns. Now, what I want to do is, to make this point, all I did was I took these 3 years and I swapped them from the top to the bottom. And then I took these 3 last years and I put them up at the top. Okay, so you can see the 13.41 is right here, the 29.6 is right here, 11.39 is right here, and then those 3 negative years are down here. And then all the years in between are still the same. So you can see these match up right across: 20 minus 38, 3.13, 3%, 8.9. Which means our average annual return is the exact same as 4.07%. But because we didn't lose money in those first years, we still took out the same amount. We still took out that 40,000 a year. Look at our balances. The sequence of those returns makes a great difference. Same average annual return, but because we're not selling our shares at a lower price, we're able to maintain those balances. And so you go from having 273,000 to 890,000. So you're going to hear me say a couple of times during this presentation, I'm going to remind you of one of the golden rules of investing is buy low and sell high. Okay, that's the rule, but that's not what we end up doing, is it? Because you have to maintain your lifestyle, you're forced to sell those shares, whether it's mutual funds or stocks or bonds, whatever you're selling, to get that money out of there, you're selling them at a lower price, which is even a bigger drag on your portfolio. Whereas if you're able to sell them at a higher price, that works out better. You don't sell as many shares. So when the market does come back up, you're making even more compounded money. Okay, so the sequence of those returns makes a difference. The average annual return is much less important at this stage. Okay, so we can look at it here in this little flow chart. If you need to take withdrawals during a down market, it's in effect doubling the hit to your portfolio. So you need to take the withdrawals, but you sell low without the ability to put money back in because you're not working anymore, you're retired, and buying low. So in order to maintain the same lifestyle, you have to sell more shares to generate the same income, which means you're selling off your nest egg at a faster pace than you should have been. So how do we mitigate that sequence risk? Well, number one, you can work part-time. If you're really concerned about that, you can go back to work and get a part-time job or do some consulting. And I'm sorry, I'm looking through the messages. I just got a message that says you can't hear me. Can everybody hear me? If you can hear me, type in the chat just to make sure that you can. I should have checked that before we got started, but I'm talking for 20 minutes and want to make sure everybody can hear me. Okay. All right. Thanks, Dan. Okay. So one thing you can do, you can work part-time after retirement. Now, most people don't want to do that. That's why you retired, because you don't want to work. So maybe that's not part of your plan. Number two, you can diversify your income. You can have multiple streams of income. So maybe you can invest in some real estate that's going to provide some passive income, or dividend paying stocks, or some income producing investment. Number three, you can be flexible with your spending. And one of the biggest ways that you can make sure that you're going to be flexible with your spending is to unload your debt. You've got to get rid of your debt. We don't want people in retirement to have any consumer debt if possible. That means credit cards, car loans. Hopefully by this time you don't have any student loans, but that could be the case. Anything other than maybe your house. And if we can get your house paid off, that's even that much better. That allows you to be flexible, okay? And number four, create a solid emergency fund so that in times like this, it's a down market, you're gonna have to take out the money that you need to maintain your lifestyle, but what the last thing you wanna do is be taking emergency money out of an investment account, because that's just that much more that you're selling at that lower price. And that's just that much more compounding to the downside that you're adding to your retirement fund. So we don't want to do that. Have a nice, solid cash emergency fund. So that emergency fund is just going to be sitting in a cash liquid account. So a savings account, a money market account, maybe a checking account at your bank. We don't want that money invested in anything that's got any kind of market risk to it. And number five, consider additional financial products like life insurance and annuities. The next one would be longevity risk. Longevity risk is simply just the risk of outliving your money. People are living much longer than ever before. Modern medicine is keeping people alive. People are much more health conscious than they ever have been in history, and they're living a long time. We know that you can be expected to live to about 85 years old, and women outlive their husbands by about 7 years. So that we've got to make sure that you can not outlive your money. We've got to make sure that your money lasts as long as you do. Look at the rate of increase here in the life expectancy. If we start this chart in 1950, that life expectancy in 1950 was 68 years old. And then we're going up here to 2020, and what is that, about 79 probably? Yeah, it looks like about 79. So when I said 85, that's the IRS mortality table. There, the IRS is expecting you to live to about 75. Let's see, I'm not sure where this data comes from, macrotrends.net. So it's not the IRS, but IRS and Social Security Administration expect you to live about 85. And wives outlive their husbands by about 7 years. So we've got to make that money last. And how do we do that? Well, if we look at the traditional ways, the old rule was the 4% rule. The 4% rule said that you could take about 4% out of your retirement accounts every year and not really risk getting into your principal even. Well, that rule was kind of set up a long time ago in the 70s, really, when CD rates at the banks were very high. I mean, it was not uncommon throughout the 70s and into the 80s to see certificate of deposits paying double-digit interest rates. I remember my grandparents only had CDs and they paid 10% or more. And I remember my grandmother just throwing a fit because her CD renewed and the bank was only going to pay her 8%. And of course, I didn't really know what that meant at the time, but I can remember my dad having that discussion, or just having a conversation with her, and she was just flabbergasted that they were only going to pay her 8%. Well, that's about 7% more that they're paying right now, and 7% more than they're going to pay for about the next 20 years, according to the Federal Reserve. This low interest rate environment that we're in is going to last for a long time. The last chart that I saw from the Federal Reserve, rates are going to be flat until about 2028. And then they start just barely creeping up. Now that's an estimate, and all kinds of things can happen, but with the Fed's history so far in the last decade or so, every time the market drops, they lower interest rates. Well, there's not much place to lower them, when you're at zero already. So every time they creep up just a little bit, like they did last year, interest rates got up to, right around 3%, maybe just as little as slightly higher, but it didn't last long. This year we're back down to zero or better, or zero, or just slightly above zero. So the 4% rule really now, when you talk to financial advisors around the country, when I talk to them, kind of the consensus is it's really more like the 2% rule nowadays. Really, out of your retirement accounts, you're not going to be able to take out more than about 2% a year and not get into your principal. Otherwise, you're going to be eating up your principal, and then you're going to run a risk of running out of money. Next would be only take out what you can afford. This is a great method unless you have high inflation years or a down market like we've got now. So just a little quick lesson about inflation. Inflation always follows a large surge in the availability or the volume of money in the market. So one way that the government, the Federal Reserve, stimulate the economy is they print money. So when you print money, what happens to the value of it? If there's more of it out there, supply and demand says it must be worth less. So although they tell us there's not a lot of inflation now, guess what? They haven't been shopping at HEB lately. There is inflation, and that inflation is going up, in addition to a down market. So now, not only are you being forced to take more money out of your account, not take more money out, but take more shares out to generate the same amount of money, but now that money's not worth as much. It doesn't buy as much for you. So maybe now you have to take out more. So taking out just what you can afford, that doesn't always work either, because inflation causes you to have to take out more. And then as you begin to age into your retirement years, then come in healthcare costs. The inflation rate on healthcare, if we single it out, is about 2 times that of normal inflation. So if the historic rate of inflation is 3%, well, then the healthcare costs rise at a rate of about 6% per year, especially on seniors. So that really puts a strain on your accounts. The RMD method, so RMD stands for required minimum distributions. That is for your IRAs and 401ks and 403bs, all your qualified retirement accounts. When you turn 72, they changed the date, they changed the law this year. So if you're not already taking RMDs, then you can wait until age 72. It used to be 70 and a half, now it's 72. Now, if you're already taking them, you can't stop. You have to keep doing it. But if you were not yet 70 and a half by January 1st, then you can now delay that to 72. But at 72, you have to start withdrawing money out of your IRAs and paying taxes on that money. That's called an RMD. So the RMD method says that you're only going to take out what the IRS requires of you, and then your money, based on the IRS mortality table, should last for the rest of your life. But what the IRS doesn't calculate for is emergencies and unforeseen circumstances. They don't calculate for market fluctuations or high inflation environments or low interest rate environments or other income sources. They don't calculate that. They simply just look at your balance on December 31st and base your RMD on that amount. So they don't care that you lost 35% in February. They're going to calculate your RMD on what you had on December 31st. Okay, so you're going to have to take out more money, a higher percentage of what you currently have. Again, selling more shares than you should have, buying high and selling low, the opposite of what you should be doing. So how can we do it the right way? How can we help mitigate that longevity risk? Well, number one, we can spend safely. Evaluate your purchases. Don't buy things that you don't need. I'm not saying don't have any fun, but just think it through. Don't be frivolous. Calculate your longevity risk and retiring when it makes sense. So we look at your health and look at your family history. Do you have longevity in your family? Does everybody in your family live to be 100? That plays into this decision. We need to make sure that we're looking at the big picture. You may need to work a little bit longer, or you may need to work part-time in retirement. You may need to have passive income sources like real estate or some income producing financial products. Behavioral risk. This is the hardest one. The first two are pretty concrete. We can feel those and we can respond to them and we can adjust to them. The behavioral risk is a little more abstract and a little bit tougher to correct because, you know, that's our behavior. We've got a lot of years of developed habits, and sometimes those habits can be hard to break. Investor emotions can overpower that rational thinking, both in bull and in bear markets. And our two biggest emotions that affect our investing are fear and greed. There's typically four types of investors: the preserver, the follower, the independent, and the accumulator. Well, which one are you? We're going to talk about these, and I want you to think to yourself as we're talking about them, which one are you? The preserver. The preserver is kind of a passive investor, so kind of a buy and hold kind of investor. They value financial security and wealth preservation more than growth. So at this stage, they're much more concerned with safety than with growth. They're risk averse. They don't like to take chances with their money. They may, probably not go into casinos and gambling. They're less satisfied with gains and more dissatisfied with losses. And they have a tendency to sell winners and hold on to losers. And that's kind of, you're going to see this pattern come up more and more. And I've mentioned it before. We end up, because of these patterns that we get in, buying high and selling low. You're supposed to hold on to the winners and sell the losers, but the preserver does the opposite. The follower is also a passive investor, and they tend to comply with advice from friends and family and colleagues, and they can make abrupt decisions based on the urging from a friend or a family member. So this is the person that takes the tips from their golfing buddy that says, "Hey, I just bought this hot new stock and you should get in on it too." And so you do, and you go and buy it. But the problem is, by the time you've heard about it, it's kind of at the top, it's at its peak, and now it's time to start cycling back down. So you bought high, and you're going to hold on to it all the way to the bottom until you finally get fed up and you sell it and cut your losses and you sell low. Your biggest fear is regret. You have this terrible fear of missing out. You're afraid to make the wrong decision, and with conflicting advice from friends, families, and colleagues, the follower may avoid making this decision. That's what causes them to hold on to those losers and losing investments and ride them down to the bottom. The next one is the independent. Independent is an active investor, so not just buying and holding, but actually actively managing their assets. They act quickly and decisively, and they're confident in their own research. They're avid researchers and very informational consumers, very much informational consumers. They do a lot of research and make sure they're well educated on a topic before they make a decision. However, because of that, they may become a little overconfident in their research, and they often make decisions based on positive or negative outlooks and reviews. But then they have, because of that overconfidence, they may have a tendency to be a little bit inflexible and not be willing to give up or change their mind when they need to. The last one would be the accumulator. The accumulator is also an active investor type. They're risk takers, but they have strong conviction and confidence, and they're often successful in business and want to carry that success on into their investing lives. And their biggest flaw is their overconfidence. They have this false sense of control and often take unnecessary risk and overestimate their skills. I see this a lot in my retired day traders. They are retired and get this idea that because they were successful in life that they're going to be successful in their trading. And day trading is very hard and very risky, and it's not something that most people can do part-time. But this is kind of where this accumulator type gravitates to, and they struggle to stick to a consistent strategy. So they kind of bounce around between strategies. They chase shiny objects and get distracted easily. So which one of those are you? Are you a preserver, follower, an independent, or an accumulator? Typical investor emotional cycle works kind of like this. If we're looking at the market, this red line here is simply the S&P 500. We're looking since 2004. You can see coming out of the dot-com bubble and 9/11, we had this sense of optimism as the market was coming on up, and excitement, and our emotions were thrilled. And then we get to the top and we're in this sense of euphoria. Everybody's fat and happy. And then what happens in late 2007, 2008, the real estate market starts to crash, and it gets kind of scary, and you have this sense of anxiety, denial, fear, desperation, panic, capitulation, despondency. You go, oh, I just can't take it anymore. And so what do? You sell everything, you get out of the market, you bought high over here and you sold low over here. And then of course, what happens? Like every cycle in nature, starts to come back up. And your mood starts to get better. You're no longer despondent, you're just depressed. Then you have a little bit of hope, relief, optimism, excitement. This is where you're getting, it's a little dangerous, because this is where the followers get in right here from the tips from their friends. Thrill, it's really good euphoria. And then what happens towards the end of 2008, we start turning back down. 2018. 2019 was a good year. And then of course, you all know what's happened in 2020. This is a natural cycle. It happens all the time. If you go back the history of the stock market, you will see these cycles. But the problem is, humans are emotional beings. We act not on logic, but on emotion. There's some people that can act on logic. They're few and far between. Most people act on emotion. And this emotion is what causes us to buy high and sell low, and buy high and sell low. There's a study that comes out every year. You can look it up if you don't believe me. It's called the Dalbar study, D-A-L-B-A-R. And what the Dalbar study says every year, it's very consistent, is that individual investors underperform the market by about 50%. And that is because of two things: fear and greed. You make the wrong decision at the wrong time. So how do we mitigate this behavioral risk? Well, we avoid making emotional decisions. Avoid that emotional roller coaster that cycles with the market. So the first thing you can do is work with a financial advisor, a financial professional who can help you put a written plan together and help you stick to it. That financial advisor will help you understand your own risk and comfort level and tailor that plan to that risk tolerance, which will in turn help you not make sudden actions without first having a written strategy in place for both the low periods and the high periods. It's important to know what to do, not just when the market's down, but also when the market's up. Financial professional can help you diversify your retirement income, avoiding all the eggs in one basket problem. You know, you always hear that. You've heard that. You need to be diversified. You also want to not be too closely correlated. So there's a difference between diversification and correlation. And then you can dollar cost average. You know, when you were working, you were putting a little bit of money in every month. That's called dollar cost averaging. And then when you're not working, you dollar cost average in reverse. You take a little bit out every month or every year. The more frequently you can take those systematic withdrawals helps that dollar cost averaging though. So how should you respond to a bear market? Well, if we just look at the last 11 bear markets that we've had, we go back to 1946, we know that it takes about 16 to 18 months to recover, with the average really being about 16 months in the S&P 500. So we go back to 1946. That one lasted 3 years. It took 36 months to come out of that bear market and get back into positive territory. More recently, we can look at 2000. So that's the dot-com bubble you're also familiar with. Also in there was 9/11. That didn't help things. That one took 2.5 years, 2.5 years to get out of. And then the credit crisis, the real estate crisis, 2007, towards the end of 2007 to, you know, really kind of hit that bottom in March 2009. Took 17 months to get out of that bear market. Okay, so I don't know if this one's going to be the same. It might be like, you know, this flash crash in 1987, not flash crash, but the Black Monday in 2007. You know, it only took 3 months to get out of that. And same thing in 1990. But the average, you can count on about 16 months. It's going to take a little while for this one to come back. If you look at 2018, Christmas 2018, Christmas Eve, actually, we had the worst Christmas Eve in the markets in a decade. And, you know, market crash, I don't remember what the numbers were, but it was big. It was the worst Christmas Eve in a decade. And we had what's called a V-shaped recovery. So the market came back just as quickly as it went down, came back up just as quickly as it went down. So the chart, if you look at the chart like they show you on television, it looked like a V. It went down and it came back up. A lot of people were saying right now what we're in, it's caused by the shutdown. As soon as the shutdown is over, everybody's going to go back to the work and the market's going to come back. And we're going to have this V-shaped recovery. Well, it's not happening. The V is not there. Now, depending on what market you're looking at, if you're looking at the NASDAQ's already recovered all its losses. The S&P 500's getting close. The Dow Jones, not so much. But here's what I think. I think that we've got a couple of things coming up that are going to affect the duration of this downturn that we're in. Number one is the coronavirus. This is something we cannot control. This thing may have a second wave that's significant, or it may not. I don't know what's going to happen there. What I do know is that most of the country is still shut down, including here where we're at in Texas. And Texas was one of the early states to start to reopen. You know, as I drive around here, just lots of traffic and people out and about. But I was in my office in San Antonio the other day, big 4-story, big office building, and normally this is a huge parking lot that's full. And I mean, you can't find a parking place in it. You had to drive around for a minute to find a parking place. And there was about 10 cars in the whole parking lot just this week. And so we're in phase 3 of the reopening of the state of Texas from coronavirus, and there were 10 cars in the parking lot. People are not coming back to work. A lot of people are still working from home. I understand that. But a lot of these job losses are going to be permanent. They're going to become permanent. So you saw today the new jobless numbers came out. Today we had another 1.5 million people apply for unemployment in the past week. So that's, what is that, 45, 47 million people now out of work since this thing started. Some of those people have gone back to work. I think most have not. And I think most are not, quite a few are not going to go back to work. And here's another thing to know. Was something part of the CARES Act called the Paycheck Protection Program, the PPP. These are these forgivable loans that the government gave to businesses, and mostly small businesses, but some big businesses too, that gave these businesses money to continue to pay their workers while they were unable to go to work. So if I'm a restaurant owner or some non-essential business, and I was forced by the government to close my doors, I had two choices. I can either lay my workers off, fire them, and not pay them, or I could pay them out of my pocket, out of the goodness of my heart, just because it's a good thing to do. And if you're in a position to do that, that's great. That's what you should do. And then when the CARES Act passed, the government said, we're going to give you some money, and as long as you use it for payroll and a couple other qualified expenses, this loan that we're going to give you, we're going to forgive it. And in order for that loan to be forgiven, you have to have the same number of employees on some date in June. I don't recall what the date was, in the June. Same number of employees in June that you had in February. And if you have the same number of employees on your payroll in June that you had in February, then we will forgive this loan and you don't have to pay it back. So here's what's going to happen, folks. I'm going to make a prediction right now, and you can mark it on your calendar. When that date in June comes, and these big companies, you watch the airlines first. When these big companies get that letter from the Treasury or from the Small Business Administration, wherever they got that PPP loan from, saying that, okay, you met the requirements, your loan is forgiven. Watch this. Mark my prediction right now. You will see massive layoffs, massive layoffs. These people are already furloughed. They're not working. They're only being paid by this government loan. The industries have not come back, especially airlines. So you watch. There's going to be massive layoffs at the end of June, July, August. Massive layoffs. A lot of restaurants, I can already see around town, restaurants are permanently closed. I'm starting to see for lease signs go up in a lot of commercial real estate. You're going to see a lot of businesses not go out of business, but say, you know what, this working from home thing kind of worked out. I don't think we need to own all this big giant office building. Let's sell the building and let everybody work from home. And by the way, we found out that people can work from home and actually do a little bit more work if they're not distracted here in the office. So let's lay off 25% of the workforce. You watch. The economy that we're in, the business world that we're in, is going to be changed for a long time. And this market is not going to come back quite as quickly as the government economists would have you believe. So that's my thoughts on the bear market and how you can protect yourself from it. Number one, have a plan, have a written plan, have a diversified portfolio with several different asset classes, not only that produce capital appreciation, but produce a diversified and multiple streams of income, and some hopefully with some guarantees that you can use to avoid this trap and this vicious cycle of buying high and selling low. Something else that's very important, I always like to talk about this, is have some information together that your family, somebody that you trust to take care of your affairs, can get to. You know, in my business, all of my clients, almost all of my clients, are over age 65 and are at the most vulnerable to this disease that's going around. And I've had some have, get coronavirus and have problems, and had family members come to me asking about their insurance and their legal documents and their investment accounts. So please get all of this information together, put it in a binder. My wife and I have a binder at our house. It has all of our information in it. There's a couple of our family members that we trust that know where that information is and can get to it. So it's got our medical information, our health insurance, our doctors' names and phone numbers, our legal documents, our wills, powers of attorney, medical directives, all your personal accounts, your computer usernames and passwords, your bills, your social media sign-ins, your passwords for those things, a list of all your service providers, so all your utilities, internet service, alarm codes, extra keys to the house and cars, directions for anybody that you need taken care of, like any dependents that you have, your pets, plants, your house. All of these should be given or at least disclosed to a trusted loved one, somebody in your family that you trust, somebody that you trust to do these things for you should have at least knowledge of where they can find all of this information. So questions that you need to ask yourself right now. Number one, am I taking too much market risk? Number two, how should I act if the market continues to drop? It's kind of scary right now. What should you do? Number three, am I diversified enough? And not only am I diversified, but am I correlated? So we didn't really cover that too much, but just because you're diversified doesn't mean that you're not correlated. So you may be well diversified, maybe you own 25 different mutual funds, but when you dig into those funds, you find that all those funds kind of own all the same companies. So you may, though you're diversified, you may be very closely correlated. So all your accounts go up at the same time and all your funds go down at the same time. So we want to avoid too much correlation, which can be masked by this sense of diversification. So am I diversified enough? Next, is my portfolio right for my age? Am I investing at an age appropriate level? And lastly, does my portfolio fit my financial goals? I talk to a lot of people every week, and I find that when we're having talks about their money and about their investments and about their retirement funds, that what they think they feel as an investor, what they think their risk tolerance is very often not the way they are invested. So again, most people that come to me at age 65 are more conservative with their investments. They're not risk takers. But when we dig into their investments, we find that they're still invested pretty much to the risky side. It just doesn't match. So their investment plan, their financial plan is not congruent with the way that they feel that they should be invested. So does your portfolio fit your financial goals? Folks, if you can't answer each one of these questions definitively, if you don't have a definitive answer to all 5 of these questions, you need to come see me and I will get you these answers. So we will just take a quick look at your portfolio. Just bring me your statements. We'll take a quick look at them and have a little chat. I'll get a little bit of information from you. I can do some in-depth financial planning if you like, and get these answers for you. These are really questions that you should have an answer to. If you don't, you may have a problem. So come on in and we'll help you out with that. So here's my offer to you. I really appreciate that you spent some time with me today. We're almost at an hour, and so right on time. I really do appreciate it. I know that at 6 o'clock in the evening, you'd rather be doing something else than sitting here listening to me gab about the stock market. So in exchange for that, in reward for that, I'm going to buy dinner. All you have to do is come in and sit down with me and have a chat about your finances. So come on in, bring me your statements. We'll take a look at them. We'll get all these questions answered for you. and dinner's on me. I'm going to give you a gift card. We can't do seminars anymore right now, so we can't have big group dinners like we used to, but I will gladly give you a gift card for a local restaurant, and you can have dinner on me. So I've also got a couple other resources here in the office, a couple of pamphlets and books that you can take with you as well. So it's real easy to do that. Either call the office here at 830-217-6711, or if you look in the chat box, it's there, but I am also going to type it in again. There is a link to my personal calendar. Click on that link. It says calendly.com. Click on that link and it will take you to my personal calendar. You can schedule that appointment at your convenience. So do that, folks. And I really appreciate you being with me tonight, taking the time. If you have any questions at all, please give me a call or send me an email. I love to answer questions. I love to talk about this topic. It's one of my passions. And one of the ways that I love to help my clients out is to answer these questions. So have a safe rest of your week, safe, happy weekend, and we'll see you soon. Thanks, folks.